Thought leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. Today's episode stays focused on SEC topics, but with a discussion of foreign private issuers, commonly referred to as FPIs. Many of the considerations we talk about for other SEC filers also apply to FPIs. However, there are some differences and some added complexities. So today we're bringing you an episode all about focus areas for FPIs in particular. What's the same, what's different, and what unique issues should FPIs gear up for this reporting season?
The FPI world, when we think about it, there's close to 10 trillion of market cap of FPIs. And I heard that statistic recently from Paul Munter, and it really just made me pause as to the size and scope and scale of the FPI community. It's about 20% of the registrants on the exchanges.
That was Patrick Higgins, Deputy Chief Accountant responsible for the Foreign Private Issuers Support Team in PwC's National Office. He's joined by Kevin Vaughn, a partner in the National Office who previously spent nearly 2 decades at the SEC on the other side of these comment letters before joining PwC. With us again as the special guest host for this series is Kyle Moffett, PwC's National Office Professional Practice Leader, who also previously spent almost 20 years with the SEC. This group has a lot of insight, so let's play the episode.
Patrick, Kevin, thank you for joining me today. I'm excited, very excited to chat with you both about what's going on in the foreign private issuer space. Patrick, as our foreign private issuer leader and a member of the Center for Audit Quality's International Practice Task Force, you engage quite often with the SEC, you engage quite often with clients, and so love to kind of hear you kick off this discussion. Just talk about transaction trends in general in the FPI space.
Yeah, first and foremost, the FPI world, when we think about it, there's close to 10 trillion of market cap of FPIs. And I heard that statistic recently from Paul Munter, and it really just made me pause as to the size and scope and scale of the FPI community. It's about 20% of the registrants on the exchanges. From a deal activity standpoint, I would call it green shoots. So we had a high water mark in 2021, and we know for a variety of reasons, the past, call it 3-4 years have been relatively slow, both from an IPO standpoint, but also just general M&A trends. In the last 6-9 months, the deal volume for M&A has gone up dollar-wise by about 5%, but it's been concentrated in a, I would say relatively fewer number of M&A transactions. But that's starting to slowly shift. In the IPO markets, they're certainly up 2024 year to date versus 2023. A couple of noteworthy statistics there. One, we're still about half of, not even half, the volume from 2021. Oh, wow. So it's still a sort of moderate, what I would call a moderate pace of IPOs. And when we think about the IPO types, 2021, we had a lot of SPAC IPOs. Right. Those are in the single digits. So the SPAC IPO, I think as a result of some of the rules, but also the mixed success that some of those SPAC IPOs had, you are not seeing as many of those, but definite green shoots. I see the end of 2024 setting up for a relatively busy transaction season in 2025.
Gotcha. Kevin, you spent a lot of time at the SEC before joining PwC, and you were many different roles. You started in the Division of Corporation Finance, who are the staff that reviews filings, and they're the folks you meet with, Patrick, on a regular basis. Can you talk us through kind of the SEC staff comment process, the staff review process, and how that works with respect to foreign private issuers and foreign registrants?
Yeah, no, absolutely. And for domestic companies that are familiar with it, it's actually the same process that domestic companies go through. So foreign private issuers, foreign registrants, they're all required under Sarbanes-Oxley. The staff is required to review them once every 3 years, the same as they do domestic companies. And that review process is really entirely the same. They look at the company's filings. You have the foreign private issuers who are filing on Form 20F, their annual report, as well as like F forms for registration statements. Those all go through the same review. Other foreign registrants are probably using domestic forms or whatever the case may be. And also, like a lot of those foreign private issuers are permitted to use IFRS or even a home country GAAP. There's not too many companies left that use home country GAAP. Most companies use IFRS, and they could do that without reconciling that to US GAAP. If they use another home country GAAP, they would have to consider the reconciliation requirements for those. But the SEC staff is well educated, well versed in IFRS. They've been trained on it. They stay up to date on it, and it's the same people that are asking questions on domestic companies on US GAAP issues are also the ones asking the comments on IFRS issues. And as we get into some of the comments later, I think you'll see clearly that the staff is focused very much on accounting issues from an IFRS perspective as well.
Interestingly, I think it's not just the IPOs that the staff reviews, right? The staff is required to review, 20F or whatever other filings, right? If it's, once every 3 years. So the Sarbanes-Oxley Act requires that. And so to your point, right, the staff, when we were at the staff, we spent a lot of time, getting training on IFRS, getting up to speed. You have about 200 people in the division reviewing filings, or at least, accountants. And so they get it. They know IFRS. They know their foreign private issuer rules. And so, obviously, I think you also then spend a lot of time in the office of chief accountant. And so the staff in that role, you guys always educated the staff in Corp Fin on IFRS matters. You dealt with consults on IFRS issues, right? So it was like you were doing US GAAP and IFRS, right? Kind of hand in hand.
Yeah, and the Office of Chief Accountant, they have an entire international group in that office that focuses on international accounting and auditing, and they're very plugged in with international regulators, with the IASB on standard setting efforts and all of that. So yeah, they're very, very well informed and involved in the process, and they share that knowledge throughout the agency.
So with that tee up, considering how many of the standards, not all, right, but how many of the IFRS and US GAAP standards are, either fully or mostly converged? Patrick, it seems to reason that many of the common letter trends, may be similar to what we see in the US GAAP side of the house. Can you talk a little bit about that, what we're seeing?
Yeah, and that's true, Kyle. I mean, the comment letters, the top 5 areas for comment are nearly identical between IFRS and US GAAP. They always change a little bit over time just because the registrant populations are different. But when you look at the top 5 for IFRS, I don't think anybody's going to be surprised by them. First and foremost, non-GAAP. You have MD&A comments, segment reporting comments, revenue recognition and revenue comments, revenue disclosure comments, and last but not least, financial instruments. Financial instruments just replaced business combinations like a month ago, so that's new data. But listen, business combinations is 6. So between US GAAP and IFRS, the top 5 are generally consistent.
And that makes sense with what you said earlier about the biz comms, like the transactions, like a little bit slower. But like when you think about financial instruments and the complexities there, it seems to reason that would move up. So that makes sense.
Does make sense.
Yep.
So just thinking about non-GAAP for a second. So it's not uncommon in a 20F periodic filing for registrants to put non-GAAP financial information in that filing. So, and they may also put it quarterly in a 6K filing, which is subject to different rules than a domestic registrant might have. Specifically, foreign registrants don't have to think about Reg G in a press release like the domestic registrants do. And the non-GAAP comment letters for FPIs, very similar to domestic registrants. What I like to focus on are the comments that either our clients received or I saw in the marketplace that actually drove a change in the registrants reporting moving forward. And, the the number one area for comment on non-GAAP companies' non-GAAP disclosures for FPIs, I think domestics too, are individually tailored accounting principles, right? And I like to describe those. These are my own words. You're not going to find them anywhere else. But that's where a company doesn't necessarily.
Well, the staff made up the ITAP term too, so.
No, but in my own words, what an ITAP is, or an individually tailored accounting principle, is when a registrant doesn't necessarily prefer the way the GAAP works, they apply a different measurement and recognition standard to get to their non-GAAP results. So one common area this past year that I've seen in the foreign world are inventory adjustments. So think a write-off to inventory. Think something that skews a company's margin, like maybe they have an input cost that's based on a commodity and that's always going to be fixed. And whether the commodity goes up or down, that's going to skew their margin. So it's not uncommon in the past for registrants to say, hey, that's not really controllable. That's not part of our core business operations. And accordingly, we're going to take that out of our non-GAAP results. Recently, about a year ago at last year's SEC conference, the staff talked about inventory and they said, hey, registrants, put on notice if you are making adjustments to inventory, you need inventory to run your business. So that would seem to be an ongoing normal operating cost and not something that would be taken out of non-GAAP results. And I can tell you, I've seen a number of registrants get that comment since last year's AICPA conference, and have to change the way they measure their non-GAAP adjustments related to
no
inventory.
No surprise.
Forward.
I mean, I've seen it in the domestic space, and I think we continue to see it pop up. So that's interesting. I hadn't even thought that about the foreign private issuers also kind of doing the same thing.
Yep. I mean, the other one that's out there are metrics that the staff ask the company, hey, is this misleading? Yes or no? And the one that often comes to mind for me are, companies that operate in industries where they get big upfront payments and their revenue recognition, just because of how the standards work, can be a little, my words, lumpy, right? And they say, hey, we're going to adjust our revenue and present an adjusted revenue metric, maybe a cash-based revenue metric as an example. And I've seen the staff say, well, company, you say in the fore part of the document, you're in business to make revenue, and you're adjusting revenue not for something like constant currency, but based on when you get cash.
Right. Yeah.
That doesn't necessarily seem to be the most straightforward way to present revenue. And accordingly, we believe that's misleading, and I've seen registrants change their reporting based on that comment. Yeah. So the message I always try to give our foreign registrants, other than constant currency, it's really not a great idea to adjust revenue and inventory. Of course, talk to your advisors. There could be that 1 in a million circumstance, but that's generally the advice that I provide. And then to round out non-GAAP, I would call the rest of the comments that I've seen that are most common are really disclosure related. So not reconciling to the right metric, or maybe not clearly articulating exactly what all of the non-GAAP adjustments relate to, and forgetting the reconciliation. I've seen that a couple of times where registrants have presented multiple measures and then, unfortunately they don't reconcile all of them. So all good things to keep in mind as the year end closes out. The last thing I would say on non-GAAP, in particular for our FPIs, it's really complicated because there are multiple jurisdictions and multiple regulators involved, and what may work under one reporting regime may not work under a different reporting regime, and tacit agreement to a non-GAAP measure in one territory may not be explicit agreement. What I mean by that is just because a regulator in another territory hasn't commented on a non-GAAP metric, it doesn't mean that they absolutely agree with it. And oftentimes our FPIs think that, they do because it's used in, their home country, but the SEC rules and interpretations are definitely different.
And they can impact that.
Yeah.
Yeah, and I just to add in, I think on non-GAAP, because it's such a big topic, right? And it's all the time. It's what we're talking about, both domestic and FPI. And so, just maybe a little bit of a plug. I think right before the holidays, I think we're gonna do a podcast on non-GAAP. Kyle, you and I, as well as Lindsay McCord. And so we're going to talk about some non-GAAP trends, some similar here, but certainly I'm going to put in a pre-plug for that podcast. It'll be entirely focused on non-GAAP as well. So.
Well, and look, I think the other piece of this too, right, is, the staff does have, there's a lot out there, right? Like we talked previously about your role on the IPTF, right, with the CAQ's IPTF, which, that there are minutes to those meetings. We certainly encourage people to listen or look at those. The financial reporting manual that the staff has published on their website, people can look at that. I mean, so there's plenty of guidance out there, but I think the interesting point that you made, Patrick, on that topic is hey, ask people, right? Talk to the experts. You're an expert. You guys are both experts in this, so reach out to the respective experts in these areas. So I want to transition now, Patrick, to segment reporting. And I know that this is an area we've all been talking about quite a lot, especially with the domestic, the changes or the amendments to the segment standard under U.S. GAAP. But can you talk a little bit about what's going on in that space?
Yeah, it's a frequent area for comment, and I'll end and start with the same comment on segments. It's a really good idea each and every reporting cycle to take a look at the CODM package. What's in it? What's it say? How is the business described in that package? How is the business described in the MD&A? Does that line up? Do the reportable segments make sense when you look at the CODM package? A lot of the comments that the staff provides registrants are that basic. It's really, have you refreshed or taken a fresh look at the CODM package vis-a-vis what the external reporting says? And fortunately or unfortunately, a lot of times the answer to that question is no. Businesses are dynamic. The people that run the businesses, they constantly change. They want to look at new things. They want to look at new metrics. They have new competitors. They enter into new businesses. And when they do all that kind of stuff, ordinarily, they ask for different financial information. And that's why I think it's so important to refresh that analysis year over year. I mean, the common questions that we see, and in no particular order, a lot of times companies aggregate similar operating segments to get to their reportable segment. The most frequent comment that I see there is, are economically the operating segments that were aggregated, are they truly similar, right? And there are benchmark thresholds in the standards for what similar means. And often I see companies argue, well, okay, today they're not similar, but we think from a long-term standpoint they are going to be in a in a long-term basis they're going to be similar. And sometimes that argument works, and sometimes it does not work.
May depend on the staff reviewing it, right?
Yeah. Yes and no. It usually comes down to the underlying business. Like, is that a logical?
Does this make sense?
Yeah. Is that a logical argument given the business that the company operates in? Some of the comments are as simple as, show me your CODM package, because the way you describe your business in MD&A looks a little bit different from the way you report it in your financial statements. And I just want to see the CODM package, and then when the staff receives it, then they have extra questions or additional questions.
And other questions on other topics within there that they find.
That's correct. So when those are the two most common questions from the staff that I've seen that have led registrants to change their externally reported segments in their footnote. I have seen. Oh, go ahead.
Oh, no, I'm sorry. I was just going to say, and one thing, we'll talk more about, responding to comments, but segment comments generally go much longer. Like, they're usually a couple of rounds when you're going back and forth talking through this, just to get the staff up to speed. So
It's rarely ever a one response and you're done, right?
Yeah.
Like at least in all of our collective experience.
Yeah, that's true. That's true. On the disclosure side in the IFRS world, historically, a common comment was, in particular for single segment companies, if they showed multiple management, well, I'm going to call them management performance measures, but I should say segment performance measures. For companies that show multiple segment performance measures, the staff has asked, why are you showing more than one? You're a single segment company. You've reported IFRS numbers or GAAP numbers. Why the second measure of profitability? And that's been hard for a lot of our FPIs to understand. And I do think going forward with the change in the U.S. segment standard, with some of the changes in the IFRS segment standard, that perhaps that comment may fall by the wayside. But we will see, right?
They'll still be focused on it. They'll certainly be focused on it. But I think your point's a good one there, right? Because when you think about kind of the new segment standard or the amendments under U.S. GAAP, the ability to present that additional measure. Now, do we think a lot of companies are going to do that? Probably not at the outset, but maybe over time. But we've heard there are a decent number of companies interested in looking into it. So, but I'm with you there. I think we'll see questions on it, but I don't think it'll be the same approach or tone that they have in the past. So revenue recognition, you mentioned that. Well, what are we seeing there?
Revenue is obviously the most important financial statement line item in the financial statements. I mean, companies are traded on revenue multiples and the like. So obviously the staff's going to have questions around revenue. It's the most important item in the financial statements from my point of view. From a measurement standpoint, the questions that I see really asking companies about the integrity of the historical financial reporting are usually around multiple element contracts or contracts with multiple performance obligations. And those questions are often, companies, should the revenue have been recognized at a point in time? Should it have been recognized over time? Tell me a little bit more about the estimates that went into recognizing the revenue over time, depending on what the inputs were to that measurement technique. So, frequently when we think about industries, more common in tech and biotech health industries, for there to be comments in that area that talk about the revenue arrangements and whether the timing or the amount of revenue recognized was appropriate. I would say often those comments come when there's a significant contract or arrangement, and that arrangement is included as part of the filing, right? Yep. So there's a lot of rich information on, a revenue contract in the document. So it's a really good idea for registrants to definitely work with their accountants, make sure they're supporting that revenue recognition in the filing when they have those large contracts, and to make sure that they're getting to the right people at the right time. When it comes to disclosures of revenue, gross versus net, still comes up from time to time. Disaggregated revenue disclosures in the financial statement footnotes. I will say that's more common for GAAP than IFRS, because IFRS filers have a tradition of providing that information.
A lot, right?
But listen, half our FPIs are U.S. GAAP, so it's still common in that arena. The allocation of transaction price between performance obligations, I touched on that a little bit, but from a measurement standpoint, also from a disclosure standpoint, how did the company do it? How did they think about it, et cetera? So that's really what we're seeing in the revenue arena. I will also say revenue area that should be 100% converged between GAAP and IFRS. And I will tell you, from operating internationally, it's not always viewed that way in the international arena. So foreign private issuers should be really careful and make sure they are, thinking about
That's a good point.
the GAAP revenue interpretations, because I do think that's where a regulator would migrate to.
Yeah. So, I think as you were talking about revenue, I started thinking of kind of, the next topic, right? Because you're talking all about disclosures, and then the next area of focus, right, MD&A, which you fully expect to see like a rich, robust discussion of all of these elements. I know we have a podcast on MD&A as well, and so certainly refer people to that, because I think obviously that is going to apply to both domestic and foreign private issuers. But any points you wanted to make on MD&A, what we're seeing there?
I'll make a couple of overall observations on how to avoid comments, but then I'll talk about some of the comments that I've seen over the past year. In that first lens, how to avoid comments, I always say a picture is worth 1,000 words, right? So let's just talk about revenue. We were just talking about revenue. If you have a picture that shows the volume change, the price change, the currency impact, the impact of mergers and acquisitions, and then you get to a total revenue change, wow, all of a sudden a lot of questions that might have been raised or issued with respect to the changes in revenue for the current year have been answered by putting in a simple table that's less than a half page long. So think about that. Think about where pictures, charts, graphs can tell the story of your underlying business
on that
and
point,
the MD&A.
You and I both have seen a comment from the staff actually encouraging a company to do the same, to put in a chart to better explain their results and changes period over period. So I think that's a good suggestion.
Yep. So just getting to comments when maybe folks are not as proactive in some of their disclosures, just simply quantifying explanations for why things changed, right? So revenue increased by 5%. Well, that's not really an explanation. Like, why did it increase 5%? Was it price? Was it volume? Was it currency? Was it a combination of all the above? So quantifying explanations would be the first bucket. And then the next bucket of comments I would put under the broad umbrella of telling the story of the business for the year, right? So what do I mean by that? Well, let's talk about in the current year where maybe dominating the P&L results were a significant impairment, right? So, there was a massive shift in the underlying business and it caused an impairment. And companies simply disclosed we had an impairment charge of $5 billion. Well, why? What were the economic factors that drove that impairment charge? What accounting estimates were made, and were those accounting estimates sensitized in the financial statements and the MD&A? Did the MD&A take it a step further than the financial statements did? Yes or no? I will say IFRS filers generally have very rich sensitivity disclosures in their financial statement footnotes. If you take a look at a set of IFRS financial statements, they're going to be probably several hundred pages long. They're usually much longer than GAAP financial statements. So what registrants need to do in the MD&A is not repeat what's in the financial statements, but provide a little more richness and color around why those estimates were selected, like what were the options, et cetera. And that's I've seen comments on that. Liquidity disclosures are huge, right? Often analysts, others are looking at the underlying business for the liquidity. That's potentially how they're valuing the company. So repeating the cash flow statement, probably not a great idea in approaching liquidity disclosures, but also more importantly, are there key contracts where there are upcoming payments that somebody needs to understand from a liquidity standpoint that may impact the company's ability to do deals, may impact their ability to continue as a going concern, right, from a liquidity standpoint. So, there are often comments on liquidity, key agreements, right? So were there key agreements in the current year that the company entered into that had a significant impact on the entity and the entity's results, and Has that been appropriately described in the MD&A? And the last hint I would give that I also see comments would really be this notion of early warning in the MD&A. Do you see some dangerous things happening in the future? Do you see sort of dark clouds on the horizon with respect to aspects of the business? Could there be an impairment there? That's always helpful disclosure, and it's something the staff comments on when there's a big bullet charge later.
Or they'll look back and why didn't you disclose this sooner?
Yeah,
correct.
Exactly. Yeah. So financial instruments, anything there? I know that's a heavy topic. I don't know if we want to get into too much detail on that.
Yeah. But what I would say is really two or three things. First, instruments that have characteristics of debt, equity, or something in between, think preferred stock, think warrants, they can be very complex in nature. And the staff often asks about the accounting, and let's not forget the EPS impacts as well of those instruments. So that would certainly be one. And then those instruments often contain complex clauses, conversion clauses, as an example, that may require settlement in cash and could be deemed a derivative or an embedded derivative. So just registrants ought to be focused on that. And again, this is something where in the financial statement filing or the 20F, the company may have filed
I was hoping you were going to say that. Yeah.
May have filed the document.
And the
right?
staff will read it.
That's
the
right.
staff will read it.
That's right.
Just like you'll read it when you review a filing, you'll take a look and see what weird clauses are in there. And I think it's just important, like not all of these are created equal, right? You could see very similar deal, but it's obviously tailored to the company, tailored to the agreement they have with whoever, the investor, or, the other parties. So I think those are great points.
Well, there's the other thing to react to there, Kyle, is depending on your background as an accountant, right? If you're steeped in financial instruments, and maybe you worked at a bank, or maybe you were at the SEC and you worked in the banking and capital markets group, and then you transitioned to an industry group, you may have a much different view on the accounting than somebody that's been in that industry for a long, long time.
Yeah, no, I think those are fair points. Did you want to add?
Yeah, no, I mean, I wanted to go back a little bit to because Patrick and you were talking about liquidity disclosures, and you mentioned the statement of cash flow. So I feel like it's like mandatory now. We have to mention statement of cash flow and everything. It's
another
not
Paul Munter favorite, right?
That's
the chief accountant of CorpFin. You mentioned, the agency. You mentioned that earlier that. Paul is certainly out there talking about the foreign markets quite often. He has an interest in the international space, but he's also had a heavy interest in cash flows.
Yeah, and so it just a reminder there on cash flows, right? And he had the statement last year, at the end of last year, just reminding people, don't wait till the last minute to do your statement of cash flows. Think about it when you're thinking about the accounting, including if you've got complex financial instruments or whatever the case is. Think about what the cash flow implications are going to be as well at the same time. And so again, it's not necessarily in the top 5 comment letter trends, but I think, and this is similar to what you brought up on the financial instruments, when there is an issue, it becomes very complicated for a company, especially if it's determined that there was an error. Those errors can turn out to be material pretty quickly. You might quickly get to a conclusion that those are material and have to restate. So that's why we always flag cash flow as well, just for that reason.
Look, a lot of great content there, guys, on the comment letters and what we're seeing, the trends in the FPI space. Patrick, as we kind of then think about kind of phase 2 of this, it's like, okay, you get the comment letter with all of these comments in them. Can you talk a little bit about kind of, and both of you interested to hear kind of your reactions, best practices in responding to the SEC?
Yeah, the first thing that I would say is, in particular for our FPIs, they're accustomed to dealing with different regulators, not always the U.S. SEC, and the level of intensity of that regulator may be different depending on the market, depending on the company's size, et cetera, et cetera. So when the SEC sends you a comment letter, the first thing I would say is take it seriously. right? It's not a throwaway comment. They spent a lot of time. Somebody highly trained looked at the filing. They looked at your
That's debatable
website.
when we were talking about Kevin reviewing a filing when he was at the staff.
Not true. Not true. So they've put a lot of thought, and somebody has reviewed the comment that the company has received. So take it seriously. Step 2, take your time. Be thoughtful. Be complete in the analysis. Now, I know that, especially, being a client service partner, the first thing that I always said to my clients whenever they got a comment letter is, all right, let's take stock. What's happening at the company? Are there M&A transactions that are imminent?
Mm-hmm.
Is there a divestiture that's imminent? Is the company raising money? Is that imminent? Could this comment letter impact any of those timelines? Yes or no?
Mm-hmm.
Certainly, if the answer is no, then absolutely you have to take your time. You have to be thoughtful. You have to be complete in the analysis, as speed is not always a company's friend. If there is a timeline, in other words, you have a week, you have 2 weeks, make sure you fully understand the question and you have the right advisors lined up to respond, while it's expeditiously, but thoughtfully and carefully, and get your advisors, whether they're accountants, lawyers, advising accountants, and the like, lined up to give you the best advice, and make sure you're getting that best advice from the right people inside those organizations. When you get that advice, sometimes it's not all going to be the same.
Yep.
So an attorney may have one view, an accountant may have another view, and it's the company's decision as to how to thoughtfully wade through the various points of view to get to a common ground or a common point of view. The other thing that I would say is really important is every company's facts and circumstances, they're different, right? So cutting and pasting from another comment letter in your industry where you think somebody got a similar comment letter, while there may be helpful bits of information in there, that's not necessarily the best thing to do when responding to the staff. And the last thing I would say is it does happen from time to time that finance statements are updated or revised or even restated as a result of a staff comment. When that happens, the company has to remember they have disclosure controls and procedures. The external auditor is probably thinking about, the ICFR opinion, and from a controls and process standpoint, has the company done the appropriate analysis to determine whether they have a material weakness in internal controls over financial reporting or their disclosure controls and procedures. So, I don't like to leave you with a gloomy tone, but that's just those are just the facts.
Yeah.
And I just want to, I think, double down on what you said at the beginning there. Like in terms of taking it seriously, when I was at the staff, Kyle, I'm sure you probably had a similar experience. It was always a little bit of a head scratcher, but I've seen it here as well. It's not uncommon, and it may just be a cultural difference in terms of like the role of the regulator and understanding what that interaction is. But when I was at the staff, I would see FPIs respond to comments, and it was clear that they had not put a whole lot of effort into it, and they weren't necessarily taking it seriously, right? So to that point, and companies can get themselves into a lot of trouble if in that situation. If you don't take it seriously, you might get a comment back from the staff that drills down and asks 20 very, very detailed questions because they were serious on the first letter and they wanted the answers, they wanted the responses. And so really taking that time, just like you said, Patrick, taking the time, make sure you understand the comment, be thoughtful and thorough in the response, answer the questions that are in there. And these are basic things, but I have seen it a number of times where maybe companies that are located in a different jurisdiction that aren't as familiar with the SEC process, they can get themselves into a little bit of trouble there. And then the other point that I would say, we talked about a lot of these accounting issues, and particularly when you're talking about IFRS, right? And a lot of our FPIs might be subject to multiple regulators, and they're applying IFRS in all those different jurisdictions. And so theoretically, there should be consistency, but it does happen from time to time where the SEC may take a different view on an IFRS application than another country regulator. And so that happened a number of times when I was at the staff, when I was in the office of the chief accountant. And I just think it's important for companies, if you've had a conversation with your local regulator about the accounting, maybe at some point, that's helpful information to bring forward to the staff. They do spend a lot of time engaging internationally on a number of different issues, including talking through IFRS accounting issues. And certainly they would want to know if there was a difference in opinion between those. And a lot of them they may know, but certainly if you've had a conversation with your local regulator on an issue, bring that forward to the staff. There is cooperation between the SEC and different regulators around the globe. And so just from the process, the earlier you can bring that into the process, the better.
Which leads me to the other thing that you triggered in my mind as you said that is situations where we were talking about responding to comments. You obviously want a fulsome response to each comment that's issued, but there are times when there's a transaction or an amount is very immaterial, but it's not apparent to the staff that it's immaterial. And so in responding up front, make sure you say, this is immaterial to our financial statements, and provide the number, provide the percentage, the calculation so the staff can see it. Because a lot of times that can also, kind of solve the process, at least make the process much quicker, much smoother. So as we think about kind of what things look like for 2024 year ends, but then also as we look ahead and thinking forward, which we always like to do, right? Because there could be new standards, there may be other impacts, like as you said earlier, Patrick, you're talking about different transactions that may be upcoming. So what hot topics, what other things should be at top of mind for our listeners?
One of the things that I always ask registrants, usually it's in the second or third quarter, not now, but it's still not too late, is have they taken a look at either their FPI status or their emerging growth company status? So at the middle of the year, so June 30th of every year, companies have to look, am I still a foreign private issuer, right? They have to look at their shareholder base, and is it predominantly U.S. based or not? They have to look at their asset base, their principal place of business. And while that may sound and seem easy, for a lot of the foreign private issuers, it's not, right? A lot of them are, say, emerging growth companies in, pharma, biotech, in technology. And while the idea might have incubated in some territory overseas, when they transition to R&D and then, potentially a commercial organization or their tech really takes off, oftentimes it's the U.S. marketplace where that all happens, right? So the principal place of business when a company's early in their cycle and then they are growing more mature becomes a more interesting question. Same thing with shareholder involvement, right? Shareholders, as that business shows a little bit of promise, then a lot of promise, a lot of the investors with big money, they still sit in the United States. So that can change,
and that's a huge impact.
Yeah,
right. You're now in 10K world, right? You're filing Qs and K, and so it's just a little bit different.
You need to apply GAAP, not IFRS. Yeah.
I mean, you're in a different ball game.
You have to do 8Ks, right? Whereas the 8K reporting regime is much more onerous than the 6K reporting regime. So making sure that assessment or reassessment was done mid-year, in particular in organizations that don't have a big legal team, right? So that's one. And then, same concept on emerging growth status, right? If you're approaching that $1 billion plus market cap at mid-year, If revenues have grown substantially, like you really need, you should have already been thinking about it. But if not, there's still 4 months to go, right? So the FPIs fortunately have 120 days after year end. So that's the first reminder I always give, just because it's not too late. But Kevin, we had sort of hinted at it earlier. I mean, the other thing that I was thinking about that maybe I'll transition over to you. Both the IFRS and the segment standards have changed. Like, what do you expect coming up, in this year-end reporting cycle? Maybe starting with GAAP, and then we can chat about IFRS too.
Yeah, no, definitely. And it came up earlier that we've got the changes to ASC 280 and US GAAP that companies are thinking about. And specifically in there, the significant segment expenses has gotten a lot of attention because companies are going to have to include more there. But one interesting development on that front, on the IFRS front, because IFRS has not changed, and the standards were mostly, I'll call it 98% converged before these latest updates on US GAAP. But the question that came up is one of the requirements in IFRS 8 is to disclose certain additional items that are included in the segment profit. And that would be material items of income or expense that are disclosed under IAS 1. And so the IFRS Interpretations Committee, IFRIC for short, had a discussion on this, and they actually released earlier this year an agenda decision on that. And essentially what that agenda decision says is that almost similar to the 280 requirements, that if there's material expenses in there, that they would require disclosure under existing IFRS 8 requirements. And so it's a little bit different. A lot of companies, I think, historically have thought about those as really just being like really unusual items, like restructurings or impairments or something like that. But if you think about, the common example we talk about on the US GAAP front, under the new standard there is going to be, our company's going to have to disclose cost of sales because maybe that's included in the measure of profit and it's provided to the CODM. Well, the same conversation should be happening for IFRS filers. And one difference is that under the IFRS Interpretations Committee decision, there's not really this criteria of is it provided to the CODM or reviewed by the CODM. It's just if it's a material expense that's included in the measure of profit, then it will need disclosure in that footnote. So a little bit of a sleeper issue, I think, for companies if they haven't been paying attention to that. And certainly we have guidance published out there on that, and so but that's near term, right? Like this, and it's not your typical standard setting, but this is instead an interpretation, and those decisions are really meant to be applied immediately. There's not really transition given for those, but maybe because I feel like whenever we talk about segments now, we also talk about like other disaggregated expenses and other disaggregated information. So Patrick, maybe I'll flip it back to you because I think this year brought us the issuance of IFRS 18, which is
good stuff.
Another one that's going to have a lot of impacts.
Yeah, in IFRS 18, it's not mandatorily effective until 2027. But when you look at the calendar, we're already in December of 24. Well, that means the furthest year back in an SEC filing that IFRS 18 is going to be applied is 2025. Well, we're already there, right? And IFRS 18, it has a lot of tentacles to it, both from a core financial statement presentation standpoint as well as the disclosures. And probably the two most notable things for me is the income statement, which has had a traditional format for a long time, is going to look different now under IFRS. It's going to be more like a cash flow presentation with operating, financing, investing activities. So that's going to be a big change in format for registrants. And then you also have in the disclosures this concept of management performance measures, right? And what are management performance measures? Well, the way IFRS has defined them is if you provide to the marketplace, and normally most FPIs do this on a Form 6K, a press release with your quarterly financial information, and it has other non-GAAP, if you will, measures of management performance. Those measures that were broadly distributed and provided to investors and users of the financial statements, they need to be reported in the footnotes to the IFRS financial statements. So that raises all sorts of questions with respect to, hey, if I were an FPI and I, in my 6K, provided maybe 10 management performance measures, but in my SEC filings, maybe only 2, do I change that? Do I only show 2 now? Do I show all 10? Do I do something in between? A lot of complex things for registrants to think through. And I think, hey, the standard hasn't been out there. The regulator hasn't had the chance to review filings. I think it's going to be an area in the future. It's going to be for SEC huge comment.
I think that's a great point, and I think your point about getting ready now obviously makes a ton of sense in this space, but considering the impacts to the earliest period, and you'd say, well, we always recommend people do dry runs of newest standards or whatever, and this is one truly that you're going to need to be paying attention to and pay attention to it to now. But I guess before we move on and kind of the wanting to wrap on this conversation, I wanted to each of you, so spend a minute on each of these remaining topics. So Kevin, I want you to talk a little bit about climate, CSRD. Obviously Patrick, talk about kind of the SAB topic 4C issue, and then we'll close out with the inflation. But I want to see if we can hit them pretty quickly. But Kevin, we'll turn it to you first.
Yeah. So we have plenty of podcasts on what CSRD is.
Yeah, absolutely.
So I won't do that. And great podcast on that. But one of the questions that comes up a lot is what's going to be the impact on SEC reporting. So I think the big thing is, the big punchlines are, one, we don't think that you will need to take your CSRD reports and attach them or put them into your SEC filings. But it is always important to remember that the SEC disclosure rules require disclosure of material items. And so just as you would anything else, as you're going through your CSRD process and making conclusions on material climate matters or material other sustainability matters, certainly revisiting, does any of this warrant disclosure in the SEC filing?
That's a good point. Yeah.
And that could be in this year-end filing or future ones as well. But certainly, I don't think that we would necessarily recommend that you take the full CSRD report. There could be implications associated with that of putting that into the 20F. But certainly thinking about, are there material items that should be disclosed?
Yeah, just to add one thing to what you said there about CSRD reports in a 20F. To the extent a registrant's thinking about that, make sure you're talking to whoever provided assurance over that report to make sure they're comfortable about 2 things. One, that if that report goes into an SEC filing, it's likely that it won't be under PCAOB or AICPA standards, and are they comfortable with that? And oftentimes those reports are limited assurance, so not a lot of assurance. Mm-hmm. Are they comfortable being called an expert and consenting to that information if that's required? I think those are 2 things that are of utmost importance related to the CSRD reports. The reason I wanted to talk about SAB topic 4C is IPOs are ticking up, and I have seen recent interpretations through the comment letter process from the staff that companies that have, like right before effectiveness of the IPO, a change in capital structure, that the SEC actually telling an IFRS registrant, hey, you have to push that capital structure change. Think of stock split, right? Yep. You have to push that stock split back in your SEC filing, even though the opinion on the IFRS financial statements has already been issued. We talked to the staff about that recently in a company example, and they said, yes, please retrospectively revise the financial statements and dual date the auditor's opinion. And given that recent experience, I thought it was good to highlight.
Absolutely.
Because IPOs are heating up.
Oh, yeah. Yeah.
Yep. And then lastly, inflation, just because it's another one of those issues that's top of mind for everybody, certainly warrants discussion in MD&A and elsewhere in the filing. But also, if you happen to operate in a country that is highly inflationary or hyperinflationary, depending on your GAAP, then that can have some pretty significant impacts. And again, with a very short notice. So make sure you're paying attention there in terms of countries that may be considered highly inflationary or approaching that status.
Definitely a lot to digest before year end. And final question for you both. Kevin, I'll start with you. You guys have kids that are, in college, doing lots of different things, but what are the plans for the holidays?
For me, it's pretty basic, but I enjoy that. We're going to, just some good quality family time. My son will be home from college I think we'll get him for like a month. So that'll be nice.
That's the beauty of college, a nice long break.
Yep. And his sister will enjoy having him home as well. So it's just going to be nice to have everybody back in the house. And
yeah, similar for me. My daughter will be coming home from the University of Virginia. So that's exciting to have her home for a month. And one very interesting thing this holiday season, my mother has lived in Florida for the last 30 years, has decided to re-migrate up north. So we'll be helping her move in, but we're really looking forward. We're looking forward to spending the holidays with her.
Oh, fantastic. Well, Kevin, Patrick, thank you both. Really appreciate your time.
Thanks.
Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.